So here you are preparing the statement of financial position. This is a group. So you need to know what are you going to consolidate. So we need first to know the group structure. We need first to know the group structure. When you look at our information, we are told that Deru deals in real estate. The company made investments in other entities. That is Deru. Deru Limited made some more investments in other entities. That is in HL and in AL. So you have two entities here to take advantage of their strategic location. The following draft statements of the financial position have been prepared for the three companies as at 30th June 2023. So you have Deru, you have HL, you have AL. But when you look at the amounts of AL, they are in T shillings. Then others are in shillings. Okay, so it means that you have a foreign subsidiary in this question. Okay, you have additional information. You have additional information. Now, in the first few minutes, you need to immediately know what is the group structure. What are you going to consolidate? Are you going to consolidate all the entities or not? Remember, you can only consolidate if the parent holds 50 or more in the other entity. So we want to see what are we told. Just for purposes of the group structure. Note number 2, we are seeing that Deru acquired 60% of ordinary equity shares in HL. That is number 1. That was on 1st July 2022. Okay, but they are telling us that because of strategic location of HL, Deru acquired another 20% of equity shares of HL. That was on 30th June 2023. That was on the date when we are preparing the what? This financial position. This is the date when we are preparing our statement of financial position. This was not during the year. It was just at the year end. That's when you acquired another 20%. Okay. Then when you look at also another, note number 4. Note number 4, where they are telling us that on 1st July 2022, Deru acquired 80% of ordinary shares of AL, an entity based in Tanzania. Okay, so we have only that. We can have the group structure. We can have the group structure. So when you look at our group structure, you will observe that here it's Deru. Let me hope you are seeing my screen. It's Deru acquiring the so here you have Deru acquiring some. This Deru acquired some shares in two entities. Acquired some shares in two entities. The first one was HL. Then the other one was AL. In AL, in AL, when you look at note number 4, in AL, this Dell acquired, in AL, Dell acquired 80%. That was on 1st July 2022. 80%. Here, it's 80%. This was 80%. But on 1st July 2022. Then here it acquired 60. It acquired 60%. That was on first what? That was on first, when you look at our question, that was on 1st July 2022. It acquired 60% on 1st July 2022. Okay, but of course here it means that the NCI here, the NCI here was 40.
It's 40%.
Then also here it was what?
20%.
The NCI was 20%. Okay, but when you observe, that was on 30th June 2023. They acquired more 20%. So it means that you may have your revised group structure, but of course that one may not have much impact. That one may not have much impact because it is coming at the year end. Most of the things are not going to be affected because of this additional 20%. It will just because when you look at this, it came at year end. Okay, let me first do the group structure again. I first do the group, the revised one. When you look at the revised one, when you look at the revised one, this one will be 80 because you are adding more 20. That was on 30th June 2023. So it means that here the NCI is going to change and become what? 20. Okay. This is 60% plus 20, which gives you 80. So now you need to understand that this HL became 80% subsidiary on reporting date. This HL became 80% subsidiary on reporting date. And that one means that from 1st July 2022, the investment has been at 60%, leaving this 40% as the NCI, that is up to the reporting period. Okay, so what does that one mean? It means that the income and expenses throughout the year, the income and expenses for the year, you apply 60% stake. Okay, because you see this one came at the year end, and those things that happen during the year will not be affected by the what? By this stake or by this holding. Just that at the year end, when you're preparing balance sheet, obviously your NCI, as you report your NCI at year end, your NCI will be reported at 20% when you're looking at HL. Okay? So it will be only the financial position, the statement of financial position, that can be affected. If you're preparing, let's say, income statement, because income statement you're looking at during the year, you're just looking at during the year. But with financial position, you're looking at the year end as at that date. So if at all you were preparing income statement, actually this one would have no impact on whatever you'll be doing. But because you're preparing balance sheet and we need to put NCI in the balance sheet, the NCI of DERU will be reported at 20%. The NCI of HL, sorry, the NCI of HL will be reported at 20%. And we are going to see that. What is the implication? If you're holding 60% and you add more 20, what will be the impact? For the year ended 30th June 2023. All entities will be consolidated. Because all entities were subsidiary. All entities were subsidiaries. Does it make sense? Because you see, you had control in all these entities. So you have, so all must be consolidated. All must be consolidated. And what does that one mean? Now, after knowing that all entities must be consolidated, you come back at your question, lay the template very fast. But because you want to consolidate all the entities, and one of the entities is in the foreign currency, you need to translate. You need to translate these amounts, these ones. You translate them into shillings. Because when you are consolidating, you're getting this plus this plus this. Remember, in balance sheet, we don't time a portion. Even if you acquire the entity, the shares in another entity within the year, if it is not for the whole year, you don't consolidate. You don't get the money, the figure times 6 out of 12. No, you do that if it is income statement. In a balance sheet, you just make sure that add all the figures. So we are going to as we consolidate, we raise the template like this. Then, of course, as we get property, plant, and equipment, we get this 54 plus 18,200 plus this figure, but in shillings. So we need to first translate these things. And how do you translate? When you look at note number 8, they told us that exchange movements between Uganda shillings and Tanzania shillings were as shown below. So you have the exchange rates. This was 1st July, then this was 31st December 2022, then this is at year end, then this is average. Okay, so when you're translating these figures into Ugandan shillings, what do you do? First, look at how the currency is quoted. The currency is shillings per Tanzania dollar. Now it means that this is a direct quote. If they start with Ugandan shillings, if they start with Ugandan shillings, if they start with Ugandan shillings, Ugandan shillings per the other foreign currency, that is what? That is a direct quote. You'll be multiplying. But if they start with TZ, if they start with TZ, T shillings per per Ugandan shillings, that one will be indirect quote. You'll be dividing. You get the figure divided by the what? By the exchange rate. But if you see that the thing is quoted like this, that is a direct quote. As you translate, you be multiplying. Have you understood that? This is like finding that they have told you it is Ugandan shillings, let's say Ugandan shillings per US dollar, There it is still a direct quote. It is still a direct quote. You be multiplying. It is like finding that this is shillings, Ugandan shillings 1.58 is equal to 1 Tanzania shillings. This is like they are telling you that Ugandan shillings 1.58 is equal to 1 TZ shillings. Ugandan shillings 1.54 is equal to 1 Tanzanian shillings. So what if you have these figures in TZ shillings? So you will be multiplying. Okay, let me hope that one is clear. If it is an indirect quote, you'll be getting the figure here divided by the exchange rate. Okay, but this is a direct quote. You are going to multiply. So that should be your next working. The working number 2. After group structure, translate these figures. And when you're translating, okay, for the foreign subsidiary, when you're translating it, all assets and liabilities will be translated using the closing rate. This one. All assets and liabilities will be translated using the closing rate. Then the items of equity. For them, they are going to be translated using the acquisition date. Using the acquisition date. Mostly, when you don't have the rate at acquisition, or when you don't know the acquisition rate, you use the rate at the start of the year. What was the rate at the start of the year? Okay. Or when did you? Because also you need to know when you're translating. Let's say when you are translating items of equity, these are the items of equity. We be asking ourselves, when did we actually acquire our shares in AL? When did we actually acquire shares in AL? We acquired shares in AL on 1st July 2022. So because you acquired shares in AL on 1st July 2022, what was the exchange rate? What was the exchange rate on 1st July 2022? So you translate that one using this. Is that one clear? So let's do the working. Let's do that working. Now I have summarized it in this way. Now we translate these things. So we are translating the foreign subsidiary. We are translating the foreign. Are you in a position to see my screen?
Yes, please.
So this is your working number 2, translating. So these are items, these are assets. All assets, you use the closing rate. The closing rate is what? 1.58. 1.56.
The
1.56. Rather, yeah, 1.56. That is our exchange rate. Then also the liabilities. The liabilities. These are liabilities. From the question, of course, we are picking these figures from where? From here, we are translating these figures. These ones. These ones. These ones. These are liabilities. You have this and you have only this. Don't bring the totals. Don't bring the totals. Okay? Just for you pick the item. Okay, that's what we are translating. Then I say that items of equity. Now, pay attention. Let me first multiply here and I get the answer. Get this times time of the exchange rate. Okay. So here you will be getting this. Then when it comes to this one, you get this times this. Okay. So that's what you have. Now, items of equity, translate them using which exchange rate? Translate them using the exchange at acquisition date. At acquisition date. When did you acquire AL? You acquired shares in AL on 1st July 2022. And what was the exchange rate? 1 point what? 1.8. Now, pardon? 1.558. And now you in the question, you have share capital, you have share premium, all those ones, you have them. We are following this. We are following this. When you look at the question, you have share capital, you have share premium, you have the retained earning. That is the one I'm calling. You have the retained earning, then you have the revaluation reserves. Are you seeing that? So you list them. This retained earning, I am calling it pre-acquisition. Before now, this retained earning as this retained earning, you see here. I want you observe very well. You see this retained earning figure, the amount.
The 26,300.
Are you seeing what I'm recording?
Yes,
Here?
Yes.
Are you seeing what I'm recording?
Yeah.
I'm recording this 8,500. Eh? Do you know the reason?
No.
Because we are using the exchange rate at what? At acquisition date. We ask ourselves, what was the retained earning at acquisition date? So you check in the question here on 1st July 2022, they acquired 80% of shares of AL, announced the best in TZ. And what was the retained earning as at that date? The retained earning was what?
8,500.
Are you seeing that? Eh? So don't make a mistake when you're translating, because you're translating based on the acquisition. So you need, as you translate this retained earning, you need to put the retained earning at acquisition date. The one given there is at what? At reporting date. But we want the one at acquisition date. So that's how you handle. That's how you handle. Now, after this, we multiply this times what? Times this. After that, after translating, you need to get the post-acquisition. Okay, what is NCI? We don't have in this question. We saw that we don't have what? we don't have any CI. You also observed when you check from the question, no NCI, this one, there is no NCI. Okay, now post-acquisition, how are you going to get this post-acquisition? It is the remaining balance. This is just the balancing figure. Call it the balancing figure. For you to understand it, call it just a balancing figure. And what does that one mean? You are going to add the total assets, add the total assets. That's what you get when you add the total assets. That's what I have. Remember, total assets must be equal to what? Total equity and liability. So when you come here, when you have where you have total equity and liabilities, total equity and liabilities. Here the total is, it should be equal. It should be equal. Now, what does that one mean? What does that one mean? I need to get the balancing figure. Okay, so when you add just okay, I think there is no error. Let me first confirm here when I add here. I think there is no error here. So when I get the balancing figure, I get this minus this. Or another option is to say this one plus this one. We had this. That is our balancing figure. That is our balancing figure. Please confirm that that's what you have using your calculator.
I'm confirming.
That's our balancing figure.
We are right.
This is the figure. Okay. Okay, so we are done with the translating. So come back to this and consolidate here. Now come back to your template. This is Dell's group consolidated. This is consolidated statement of financial positions for the year ended the 30th June. No, as that. You get? This is as that 30th June 2022. That 30th June 2022. So you consolidate. Consolidating means what? Look at PE. You look at PPE. PPE, you add. You get this figure. 54,000 plus 18,200 plus what you have converted. What was our PPE? So we get you can be telling me this is 84,000 plus what?
No, it is 54,000.
Plus what?
It is 54,000, not 84.
Oh, sorry. 54,000, then plus
another one, I didn't get it.
plus 18,200, 18,200, then plus the other one that you have translated.
11,856.
11, this one, 11,800, 11,000. 850 what? 56. You do the same for others, like investment property. Then, of course, you'll be following your template. Investment property, then investment in associate, you first leave these ones. First leave this one, investment in it. Okay, you can put, because this one is only for the what? This one is only for Dero. We don't have associate here. So it means that this one can remain. It will not be affected. That's why you see even in my template, you have investment in associate here. It will remain there. But where you have here other investments, these ones, other investments. Remember, other investments, examiner said that other investments are investments made in what? Are investments made in HL and AL. So where you have other investments, you're going to put goodwill. You get that? Where you have other investments, you will determine goodwill. That's why you see I have goodwill here. You will do the working for goodwill. You will do the working for goodwill. Then where you have, of course, you have other financial assets. You consolidate. They get this plus what you translated. Okay. You do the same for inventory. You do the same for trade. Trade. Now, after putting your items of non-current assets, please always leave a space. Always leave a space like 2 lines, because you never know. Always leave a space like 2 lines. Me, this is Excel. I can adjust, but always leave a space like 2 lines. Then you go to current assets. After current assets, when you put those items in the question, also leave like 2 lines, because you never know. You can get a current asset in additional information. You can get a non-current asset in what? In additional information. So it's better you leave like 2 lines for security purposes. So so all these ones, I followed the template. Like here, when you check equity, where you have equity, you have share capital, share premium, retained earning, revaluation reserve, NCI. So all those ones are here. All those ones are here. Just that I introduced this component, which can come based on the required part. Based on what? Based on the required part, based on the additional information. But at this moment, items of equity from the question, you have share capital, share premium, retained earning, revaluation reserve. Then you leave like 2 lines, put NCI, leave like 1 line, put non-current assets from the question. Okay, from the question. Then leave like 1 line or 2 lines, put current assets, rather current liabilities. Then at the end, you will have to get the figure. Now, this is our template. This is our template. And as of now, you'll be having your marks. You'll be having your marks at this stage. You'll be having your marks at this stage. Remember, we have already translated. We have made the group structure. So you'll be having your marks. You'll be having your marks. Just that here, what is left is to adjust the additional information. Now, note number 3. Note number 3 is now to deal with additional information. So additional information, what are we going to? We handle one by one, or we just start with the? Okay, let's first start with the. Let's start with the intergroup transaction, note number 5. Are you seeing this note number 5?
Yes.
They are telling us that during the month of June 2023, during this month of June 2023, what happened? Deru, this is a parent, sold goods to HL for shillings 400 million. So you have HL, this is intragroup transaction. This is not intragroup transactions. Remember, all intragroup transactions must be eliminated. So here you have Deru, Deru sold to Deru sold to the other entity. What?
HL.
HL. Okay. So what was the sales amount? What was the sales amount or the disposal amount? You sold at how much as Dero? You sold at 400 million. Being at a cost plus what? Being at a
25.
cost plus 25% markup. Okay? A cost plus 25% markup. So you sold at 400 million. So it means that in the books of HL, HL recorded the purchase. The purchase at what? At 400 million. You get that? So when you're doing income statement, you first eliminate these figures. You go to where you have revenue, you remove 400. Where you have purchase under cost of sales, you also remove this. That is if you're dealing with income statement. But here we are not dealing with income statement. We don't have sales and purchases in the what? In the balance sheet. So these guys made the profit of markup. Markup was what? Markup was 25%. So for this one, when you look at the question, they are telling us that half of the goods were still in what?
In inventory.
Half of the goods were still in inventory, in inventory of HL. That is other 30th June 2023. So half of the goods. So half of the goods. So we need the closing stock or the closing inventory, which is half. Which you get a half. If you get a half of times 400 million, you remain with what? 200. So on this 200, because this is stock that is not sold, we need to determine what we call unrealized. We need to determine the unrealized profit, which we normally abbreviate it as URP, unrealized profit on closing stock. The unrealized profit on closing stock. And how do you determine this unrealized profit on closing stock? If you're dealing with markup, if you have markup. If you have markup, you get this at 25 over, increase the denominator by that percentage. So it becomes
135. 135.
That is if you're dealing with markup. If you're dealing with margin, you just get 25% times the closing stock. But if you're dealing with markup, you increase the denominator by that very figure. So yeah, what do you get? How much do you get?
40.
You get 40 million. So in this, when you have this, it means that what are you doing? What is the double entry here? You're debiting what? You're crediting what? This is unrealized profit. You want to eliminate the overstated. In the books of Deru, we want to eliminate this profit that Deru made because it is intragroup what? Intragroup transaction. So if Deru recorded the profit, for us, we want to eliminate that profit because those goods were unsold. How do you eliminate the profit? You
Retained
debit
earnings.
the group retained the earnings, which is 40. You debit it by 40 million. Then you credit what? This is on inventory. So you credit
Inventory.
what? You
Inventory.
credit, you reduce the inventory by this inventory. By this. Okay?
Okay.
Then still on the same thing, we have where they are telling us that still during the year to 30th June 2023, HL, now this is a subsidiary, sold goods to Dell. Now it's a subsidiary selling to a parent. Okay, we have another transaction. We have another transaction where HL now, it's the one selling to, HL sold to Dell, the parent. So this one, the sales is how much? The disposal amount. The
300
disposal
million.
amount is
300
300,
million.
and the percentage is 20% markup. Still, it is markup. Okay. So here it will be 300 million. So you have the markup, which is
20%.
10%. So it means that here in this one, these guys recorded a purchase of 300 million.
300 million.
Then what are we told? What are we told? But all the goods, are you seeing this? All the goods were in stock as at 30th June 2023. So it means that all these ones is closing what? This one.
Oh.
All this closing stock. Closing stock is 300 million. So it means that we need to look for the unrealized profit.
Profit.
Unrealized profit on closing stock, which is equal to what? The 20 over what? This
20
is
over
mark
120
over 120. Then times 300.
million.
What do you get?
$50.
You get 50 million.
Mm.
Who recognized the profit?
HL.
Who the profit? Who sold? The one who
HL.
sold, one who
HL is
recognized.
the one who brings the profit.
So HL is the one who recognized what? Profit.
The
And
profit.
HL is a subsidiary. So it means that here, as you eliminate one, you debit what? The group retained earning. Then also debit the NCI. Do you agree? You debit the NCI because it's HL. It's HL who recognized the profit, and you as a parent, you have interest of what in HL? What was our interest? That is 60. It was 60. It was 60. Don't bring the other 80. This 80 in what? At the year end. This one 80, this 80 came in at the year end. So for you, you recognize at what?
At 60.
At 60. This is 60 times 50.
Million.
How much do you get? Then
30.
NCI will be
40%.
times 50 million. Then here, how much are you getting? 30. 30 million. Then here it is
20
million. Then you are crediting what? The total will go to, you are crediting the inventory. You're crediting the inventory with the
50
total
million.
50 million. So it means that you need to, already you have your inventory here. You have the inventory here. So eliminate, the first one was what?
40.
The first one was 40, eliminate that 40. Then eliminate the other one is
50.
Eliminate the 50. Eliminate the 50. It's good to show that you are picking this from working number.
3.
Working number 2. Also this one you are
No,
picking
it is from working number 3.
working number 3, okay? So show that you are picking this from working number 3. Okay. You are done with this. Then when you're doing retained earning, please take note that sometimes I normally put star. Like this to know that I still have business here. I still have business here. If you're doing the working of NCI, this one will be there. If you're doing the working of retained earning, this one will be there, this one will be there. So it's good not to forget that. So
Okay.
we are done with that transaction. If it's markup, if it's margin, you get 20% times the closing stock. You don't get 20 over 120. If it's margin, you simply get that percentage, 20%. That is 20 out of 100 times the closing stock. And always pay attention on who is selling. Who is selling? If it's a subsidiary selling, it means that it's a subsidiary who recognized what? The profit. And as you eliminate, if it's a subsidiary, one portion will be eliminated from NCI. Okay? If it's a parent, everything, the whole profit will be recognized by the parent. That's why we are not apportioning here. All right, so then we go to the next note. We go to the next.
Working for.
Pardon?
Working for.
Yes, working for. Next, we are done with this. So here, working for, we need to look at, we are done with the other of intragroup. Actually, this didn't have a lot of things. Let's look at note number what? 7. Are we together? Let's look at note number 7. They are telling us that during the year to 30th June 2023, this DERU expanded its investments to Kenya real estate market. On first, this is real estate market. On 1st January 2023, DERU purchased an apartment in Nairobi at Kenya shillings. This is Kenya shillings 450 million, and made an immediate funds transfer at an exchange rate of 34. At an exchange rate of 34. This is also a direct quote. If they start with Ugandan shillings per the foreign currency, that is a direct quote whereby you'll be multiplying. But if they start with the foreign currency per Ugandan shillings, that one will be an indirect quote whereby when you are translating, you divide. Okay. So here you have they made an immediate transfer at 34. Because of the strategic location of the property, it was valued at what? Now here you're seeing that the property is being valued. Okay? Think about revaluation gain or revaluation loss when you see such kind of question, such kind of statement. And it was revalued on 30th June 2023, when the exchange rate was what? 35. From the records available, only the electronic funds transfer on 5th January 2023 appears on what? Appears on a statement. And what does this one mean? when you see something like that, in your mind, it means that these guys have not recorded the other items that could be as a result of this statement. Okay, so when you observe, you are dealing with a property. You are dealing with an apartment. This is an investment property. This is an investment property. Think about what? Yes, what? An investment property.
Yes, 40.
Yes, 40. But now, when you're approaching this, very easy. When you're approaching this, investment property. Here we are looking at investment property. Okay, so this is investment property. When you look at initially, that is how these things should be recorded. Initially, you have the property, you have the property, the investment property in Kenya. You have the property that is apartment, investment property. What was its cost? Its cost was what? Its cost in Kenyan shillings was in Kenyan shillings it was how much? That was 450. In a Kenyan shilling, that was 450. As at 1st January 2023. 1st January 2023. So you have 450. Then the exchange rate was what? This is
34.
Shillings in million.
It was 34.
This is 34. 34. That is the exchange rate. So if you want the amount in Ugandan shillings, you do what? You multiply. In the records, you have that in Ugandan shillings. That is as at first what? This was as at
1st July.
1st July, 1st January 2020.
1st Jan.
1st Jan 2023. But when you look at what we are told on 1st what? On 30th June. On 30th June, this apartment, the revaluation amount, the revalued amount, this apartment was revalued, the revalued amount. The revalued amount that was on 30th what? 30th June 2023. We are given the amount as what? 480. Then the exchange rate as what? 35.
35.
And here you get this times this. When you do this, when you look at this, initially you had recorded the apartment figure at what? At this
15.
amount. But now it is revalued at this. What comes to your mind? There is what?
Revaluation gain.
There is a gain. Wait, call it a revaluation gain. This is a gain, total gain. This is total gain. Don't rush it to call it a revaluation gain. This is just the total what? Total gain. But this total gain you're seeing here comprises of two things. It comprises of revaluation gain and the foreign exchange gain or the foreign exchange loss. It comprises of those two things. When I look at exchange rate, because it means that there is a gain, because exchange rate has increased, I need the exchange, the forex exchange gain, the forex. Are you guys still on forex exchange?
Yes, I will.
The forex exchange gain, because you see the rate has also what? has also increased. So you get the 35 minus 34, then times, when you're doing this, when you're getting the forex exchange gain, that one should be at original cost, 450, 450, a million. Here, what do you get? When you're getting the forex exchange gain, you just base on the original cost. So it will be this. It will be 35 minus 34. Then the answer you get multiplied by what? By 450. That is a gain. That is a gain, exchange gain, which must be reported under, which must be recognized as well. This one must be recognized. Then you have the revaluation gain now. The revaluation gain. Now with revaluation gain, that will be the remaining balance. Revaluation gain will be the remaining balance. This one minus this. That will be your revaluation gain. Please take note. Please take note. And what comes into your mind now? What are you going to do with these things? What are you going to do with these two items?
Revaluation. We have to adjust the investment property.
Here you are. If it's a revaluation gain,
we have to adjust the revaluation reserves.
The investment property. By what? Investment property. By this
1,500.
Don't you think that it will be the whole of this in the books? It will be 1,500. It will, because the value has increased generally. You get?
Yes.
It will be this. It will be this. Then what will happen is that the difference will now come here, what you're crediting. You credit what?
Retained earnings.
You credit the retained. You credit the retained earnings. By how much?
450.
By 450, this one. By
yes.
450. Then what else? You credit what?
Revaluation reserve.
Perfect. Revaluation, because that revaluation again will go to revaluation reserve. Revaluation reserve. So this is revaluation reserve is 1,050. Perfect. So this is what you are going to do. Do you have investment property in your records?
Yes.
Investment property, you increase it by 1,500. Then what else do we have? Do we have revaluation reserves?
Yes.
Initially it was what from the question? We had some reserves. Let me see. We had some reserves. Let me see.
34.
So you get 34. Now you don't. Now these ones you don't. Looking at items of equity as you consolidate. You don't add this and this. No, you only be looking at the parent only. You be looking at the parent only. So we get the 34,000 plus we get that 34,000 plus this. here.
1050.
1050. Okay. Then what else do we have? Let me see. For retained earning, we are going to do the working. This one we are going to do a note. And you're done with that transaction. You're done with that. You're done with that transaction. Any question?
No. Go ahead.
Okay. So note number 5. Note number 5. Working number 5. Working number 5. Working number 5, we can look at what? We need now to look at these ones. Okay, let me look at number 2, where you need the goodwill. Where you need the goodwill. You need the goodwill, you need NCI, you need retained earnings. So to do that, you have to first come up with net asset summary to get the goodwill. So here we are told that this Deru acquired this. These guys acquired Deru on. Deru acquired 60% of this on 1st July 2022. For you have the cash payment. This is the purchase consideration. When the retained earnings of HL were this one. Because of the strategic location, these guys acquired more shares for cash payment of this and the share exchange. Now, when you're reading this and you realize that in additional information you have share exchange, that share exchange will increase the share capital. So you need to pay attention. However much this transaction is coming at year end, of course, you are going to close the year when your capital has increased because of this share exchange. Okay, so what are we going to do with this one? We are told that they made the cash payment of 4,500 and share exchange as part of the consideration by Dell. Issuing 2 shares. Issuing 2 shares for everyone share acquired in HL. These guys were issuing 2 shares for everyone share acquired. This is very, 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 very key. Very, very, very key. Share exchange. You are exchanging the shares. Okay. The market share prices of Deru and HL. Now you're given also the market prices. There is a reason why you're given those market prices. The market share prices of Deru and HL were this respectively. The share exchange transactions, this is something that you need to know. The share exchange transactions have not been posted in the books of Deru. So we need to work on that, because it will have an impact on capital. It will have an impact on capital. And they are telling you that the non-controlling interests of HL stood at this. Now, when you're given that, when you're given NCI, at acquisition date, then automatically examiner is telling you use full goodwill method. You use full goodwill method, especially where you observe that there is no statement telling you that you use partial goodwill. You can only use partial goodwill if examiner has specified. But if you're given the value of NCI at acquisition, and the examiner has not talked about the method to use, you use the full goodwill method, not the partial. You can only use the partial when you're told to use the partial goodwill method. Okay, now let's first deal with
I
this.
beg your pardon on that goodwill thing.
You can only use partial goodwill method to as you do the computation of goodwill. You can only use the partial goodwill method if the examiner has specified that you use partial goodwill method. If he has not specified, ask yourself, do I have a way where I can get NCI at acquisition? If you have the way, where you can, how you can get the NCI at acquisition, automatically you must use the full goodwill method. Like now here you have the NCI at acquisition. That one alone will help you to use the full goodwill method.
Okay, thank you.
And even if you're not okay, let me not expound more on that. Okay, let's continue. Let's continue. Let's continue now. Let's first deal with the share exchange. Let's first deal with the share exchange transaction. How do you deal with share exchange? Note number 5. I am looking at the share exchange transaction. I'm looking at the share exchange transaction. Okay. So when you're looking at this, in your mind, you need two things. You need the share capital. You need also the share premium from this transaction. You need the share capital and the share premium from this transaction. Now, what you're going to do when you observe here, you have the share capital initially. Let me try. Let me try to summarize. In the books of, let's say, HL, let's say here you have, this is HL. If you look at HL, you have, initially you had the share capital. You had the share capital. Just a minute, just hold on. I think I'm copying the wrong figure. Don't you see?
The other one is for the other entity, not HL.
I'm copying the wrong figure here. It is the share capital of HL the share capital of HL is, and isn't it this one?
8,400.
It is this one, 8,400. The share capital is 8,400. This is in a million. But let me put all these things, put all the figures. All the figures. Then you have.
It is 8.4 billion.
It is what?
8.4 billion.
I add other 3 zeros,
1 0.
Like this,
No, it's 8.4 billion.
8.4 billion. Now, that is the total share capital. This is our total share. This is our total. This is our total share capital. And we need the number of shares. Then what is the par value? What is the par value? The par value here, the par value is each share. From the question, they told us that each share is what? Each share is, are you seeing this?
2,500.
2,500. 2,500. So if you want the number of shares in this entity, number of shares here, how do you get number of shares? Total capital
Divide by the value.
over the par value. So these are our number of shares. What about in the other? Okay, these are our number of shares. Now, remember, you as the Deru, you acquired what percentage? You acquired what percentage in HL? You acquired what percentage in HL? As shares acquired, shares acquired in HL. It was what?
60%.
You acquired 60. It was 60%. You have interest of 60% as HL. So here, if you get this times 60, that's your interest. That's what you acquired. That's what you acquired. Now, when you look at what they are telling us, remember you acquired this, isn't it, guys? But they are telling us that when you look at the share exchange part, they are telling us that when you acquired more 20%, you paid cash, and also what? The share exchange as part of consideration. So we want to know, as share exchange, what did you pay? Remember now, the share exchange, what you're saying is that you are issuing 2 shares for every 1 share acquired in what? In HL. In HL, you have how many shares that were acquired? You have these ones. These ones. For every 1 share you acquired in HL, you are issuing what? You are issuing what? 2 shares. You are issuing 2 shares. And what does that one mean? It means that the total shares issued, here, the total shares issued, the total shares issued to this HL, is 2 times what? Times this. Because for every 1 share I acquired in HL, I am issuing 2 shares. Let me hope this one makes sense. Total shares issued to HL. Now, after that, this is where now the logic comes in. You need to know now, what is the market price? What is the market value of these shares you issued? What is the market value or market value of these shares issued? And you are going to get this is at what? This one, who issued the shares? First of all, who issued the shares? as you're looking for the market price, you should be knowing who issued the shares, who issued those shares. Is it Deru or HL? Who issued these shares? Who issued these shares? Deru or HL? Deru or HL?
Though issued to HL.
Yes, so you're going to use the market price of Deru. You're going to use the market price of Deru. And the market price of Deru is 3,200. 3,200. So if I want to get the total market price, I simply get this times at 3,200. Oh, because of, so that's what I have as my market. That's what I have as my market value. Now, this is like investment. This is like investment in what? Investment in the HL, because you paid cash and at the same time you issued shares to HL because the share exchange. So that is like the investment in it. That is part of investment in HL. Okay. But you need to recall that these shares you issued, they were at what? What was the par value, the nominal? What was the nominal? The nominal value
Was 2,500
of shares issued. It was, each share was at 2,500.
500.
So it means that initially these ones were in your books. These ones were at this. Okay. So if you look at the market value and the nominal value, what comes into your mind? You have the difference between that is what? Share premium. Do you agree?
Yes.
So if you get this minus this, that is your share, the share premium. The share premium. Very, 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 very key. Very, very, very key. So what does that one mean? What does this one mean technically? What does this one mean technically? If you are making double entries, what do you do? What do you do? Because we are done, what do you do if you are making double entries? You debit what? You credit what? Hmm?
You debit share capital.
Of how much? You debit share capital?
Yes.
Understand that this money, you have invested this money in what? You have invested this money in HL. Do you agree? You buying shares in another company, you are investing. It's an asset. So you debit an investment, an asset, investment in HL. It's an asset. You have invested there. It's an asset. It's an asset there. So you are investing this. Then you credit the capital, the share capital, the share capital of HL here, the at nominal, this one. Then because the share capital must remain, always know that the share capital must remain at par value. always know that the share capital must remain the par value. Then you credit the difference,
Share premium.
which is
The what?
share premium. Share premium. That is a transaction that you should do. You should make. That is the transaction that you should make.
This one was
So it
kind of
means
tricky.
that pardon?
This one was kind of tricky.
Because that's why examiner didn't give a lot of transactions. Know that people who passed this, you have your mark. Finally, like this takes 4 marks or 3 marks, depending. Now we need to make some adjustments. We need to make some adjustments. Remember for you what you're going to do. You come to your share capital, your equity. We come to our equity. Our equity is where? Where is our equity? Our equity here. Record the parent. The parent share capital is what? Are you seeing my workbook? Let me go back to the question. What was the share capital of the parent? The share capital of the parent was this one. 18,000. 18,000 here. You get that 18,000. You get that 18,000. Then plus, are you seeing the share capital in your credit side? Plus this share capital. Plus this share capital. Which is 1080. Is it 1080?
Yes.
All right. And that's all. Then the premium you do the same. The premium of the parent was what? Share premium, we have this.
648.
6,480. This is 6,480. Then plus, do you have share premium from your workings?
Yes. 28.
How much?
2822.
2822. These ones you can even add. You get this 18 because I think that was the only transaction affecting. Anyway, before you close, you never know. Sometimes you need it not to rush. So that's how you are supposed to handle this. This is just investment in HL. All right. All right, we are done with that. We are done with that. And then next note. Next, still on this note, now we need to look at the net asset summary. We need to look at the net asset number 6. Number 6, we need to look at the net asset summary. The net asset summary of HL. Net asset summary, because we cannot get a goodwill when we don't have net assets at acquisition. So you have your details, and then you have at control date at acquisition. Then you have what at reporting date. At reporting date. You acquired this on 1st July 2022. Then here you are closing out at 30th June 2023. What is the share capital? The share capital here. At acquisition, the share capital remained the
200.
same. Just copy and paste. All these ones, copy and paste. What was the share capital? Isn't it
400.
8,400? Isn't it?
Yes.
Let's keep our amount shillings in a million. Shillings in a million. That is share capital. Then share premium. Share premium.
648,000.
60. What are you telling me?
It is 6,480.
From where? Share premium for HL.
It's 4,500.
It's this one. We are copying these ones. Apart from, let's say, retained earning is at reporting date. So share premium is 4,500. Then what else? What else? Items of equity, you have revaluation reserve, isn't it? Revaluation reserve was how much? 3,300. That is revaluation reserve from the question, from that question. Here, it is here. Then retained earning. This retained earning is at reporting date. That one is at reporting date. You need the one at acquisition. And how do you get the one at acquisition? Check at the time you acquired. At the time you acquired this, at the time you acquired 60. At the time you acquired 60, what was the retained earning? It was 8,000?
200.
8,200 at the time you acquired this 60. At the time you acquired 60, it was the retained earning. It was what? 8,200.
Yes.
Now, guys, because the other 20 came at the reporting date. This one 20 came at reporting date. Those ones, you know, those ones will not. That one will not have an impact. That thing will not have an impact on what you're doing. It will just have an impact on NCI. That one will have an impact on NCI. But as you do these ones, don't start confusing yourself with those things. Here it is this. This one is this. Then revaluation reserve is this. Then retained earning at reporting date. Retained earning at reporting date. Retained earning at reporting date is what? At 21,700. 21,700. 1,700. That is the at reporting date. Okay.
Okay.
Okay. So we don't have. Do we have? Let's see. Let's read and see whether we have the fair value adjustment. They are telling us. Are you seeing this paragraph?
Yeah.
Paragraph number 3. They are telling us that at acquisition date, the fair value of identifiable net assets of HL was what? In excess. Was in excess by what? By 840 million, being the fair value of what? Of the brand name. Being the fair value of the brand, being the fair value of the brand name. That is intangible asset. With an expiry date of 30th June 2018 and amortized on what? on straight line. So it means that as you look for the total net assets of HL, you will have the fair value adjustment. You will have the fair value adjustment because they are telling us these are book values. These are book values, but the fair value was in excess by the brand name because of that brand name. It means that technically, it means that the book values were less, were understated. If the fair value is excess, by that figure, it means that the book values were understated. So you need to bring that figure as a positive, the brand name figure as a positive, which is what? 84, rather 840. You bring it as a positive. It means that the book values were understated. So you increase the book values by 84 so that you can get the total fair value of net assets. The total fair value of net assets. Okay? So here what you get, you simply sum, you simply add. But as you get the figure here, because this was as at 1st July 2022, you need the figure, you need what is the value of brand name as at 30th June. It must have, you have to amortize. Isn't it, guys? You have to amortize by this date. It is no longer this figure, you have to amortize. So you need to get what is the carrying value of brand name. What is the carrying value of brand name?
As I'm getting a different answer.
When you add, you get the different answer. Here. I don't know. Let me see. This one plus this plus this plus this plus this. That's what you have?
Yes.
Okay. Then what is the carrying value of brand name as at 30th June 2023? You get the cost minus accumulated amortization. Which is what? Which is the cost is here, the cost is 840 minus the accumulated amortization. You get it is on you get this 840 divided by how many years? This is going to be depreciated for how many years? What is the useful life? Count from acquisition date, that is 1st July 2022, up to this date. How many years? You have 2023, that is the first year, 2024, 5, 6, 7, 8. Those are 6 years. Those are 6 years. Useful life, 6 years. So when I get 840 divided by 6, I'm getting just amortization expense for each year. I'm getting amortization expense for each year. But I want the accumulated. So I can multiply. By this date, this brand name has been amortized for how many years? It is only one year. Because I acquired it on 1st July and I'm preparing this on 30th June. So it has been amortized for only one year. So the carrying value will be 840 minus 840 divided by 6. 840 divided by 6. You're simply getting the amortization for each year. So do you have this in your books?
Yes.
Okay. So after that, also add. That's what I have. So I can get the post acquisition, the post acquisition profits, which is this minus this. This post acquisition profit you're getting will have an impact on your retained earning, on your NCI. Okay, so we are done with the net asset summary. We are done with the net asset summary. Okay, then we proceed to do the goodwill, note number 7. Note number 7. You need the goodwill of the what? HL. And the goodwill of HL, how do you do this? You need the purchase consideration. Purchase consideration. Purchase consideration. What is your purchase consideration? How much did you pay? How much did you pay to acquire that 60? How much did you pay to acquire that 60? Are you seeing this?
23,400.
23,400. 23,400. This one, the other one of 20, the other one of 20 will not have an impact here. Will not have an impact here. It will not have an impact here. It can only have an impact if you acquired it during the year. If you acquired it during, but mostly it has an impact when you're shifting from. It only have an impact because already you'll be having the control. It only have an impact when you're gaining the control. Let's say from 30% to 60%. There you find that we are talking about you looking at the fair value of the previous associate. Fair value of the previous associate. Then add the cash payment. The cash payment. The extra cash payment. That's if you realize that initially it was associate and now it is a subsidiary. This is what you do as you look for purchase consideration. You get the fair value of the previous associate, then plus the extra cash payment, the cash you paid to acquire the other, let's say the other 30% or the other 40%.
The extra.
Yes, the extra you paid, like the extra cash you paid. So the fair value of the previous associate, you could find that you are getting, let's say, initially it was, let's say, 35 as an associate times, let's say, the number of shares. You get the number of shares that you had in that associate, then it times what? Times the share price, times the share price at the time you changed. At the time you changed the stake. At the time you gained the control, what was the share price? That's how you get the fair value of the previous associate. Here you are in the books, number of shares you acquired in the number of shares you had. Okay, number of shares, you'll be having the number of shares. Share capital over the par value. You get it? That's how you get the share, the number of shares. Okay, that's how we handle when but for this one, where you simply have, you had the control, and you are increasing by 20. That one has no impact on goodwill. That one has no impact on goodwill. Okay, then we erase the net assets, the parents, we erase the parents share, the parents share of on the parents share on net assets at acquisition. You as a parent, your share is 60, so we multiply by what was the net assets at acquisition, 25,240. This times 25, this one. That's what I have. Then I get this minus this. And then this is a goodwill of the parent. This is goodwill, but related to the parent. Then you also now look at, because we are using full goodwill method, we look at the fair value of NCI at the acquisition date. And what was the value of NCI at acquisition date? It stood at what? That was on 1st July. It stood at 12,600. 12,060. 12,600. 12,600. 12,600. Next is that trace, you're going to trace the NCI's share. The NCI's share on net assets at the acquisition date. So of course here your shares NCI is 40 times the 25 to 40.
$10,069. 10,096.
That's what you have?
Yeah.
Okay, then what is the NCI's goodwill? This is goodwill of NCI, and it is positive. If it is positive, it means that the NCI has share on impairment. So total goodwill, you add this figure. No, you add this figure, the goodwill of the parent plus the goodwill of the NCI. That's what I have as my total goodwill. To get total goodwill, you are getting this plus this. Okay. Are we okay here? So after this, if you realize that the goodwill of NCI is positive, you will share the impairment loss. You will share the impairment loss. The group and the NCI, the group retained earning, the one will affect the group retained earning, and another will affect the NCI. But if this goodwill is negative, everything will be suffered by the parent. Okay, so here we erase the impairment loss. The impairment loss. And the impairment loss, they told us that here, they told us somewhere that where is the note that talks about goodwill? Okay, it was reviewed, that was on 30th June 2023, that that the goodwill in HL and AL be impaired by 20 and 15. So the goodwill in HL will be impaired by 20. So we get that 20%, the 20% and multiply by 10,760. That will be your impairment loss. That will be the impairment loss. Then finally, the goodwill, when it comes, the goodwill carried down, the one that you should record in the balance sheet is this one minus this one. But this is for what? For HL. For HL. This impairment loss, how do you recognize this impairment loss? You debit what? You reduce the group. You reduce the group retained earning by 60%. 60% times 2,152. Then the other one, you reduce the NCI, also debit the NCI by 40% of. Why are you bringing NCI here? Because the goodwill of NCI is positive. Then the remaining balance goes to what? The remaining balance goes to what? Impairment. It goes to what? The goodwill, eh?
It goes to asset goodwill.
Goodwill. Okay. So already this one you will be having it already. It has been reduced. Eh? Okay. This one is 60% times the group retained earning 2,152. Then here it is 40% times 2,152. And here just add this one plus. Now, when you're preparing income statement, the impairment loss directly goes to income statement. And either it can be under administrative expenses, you just take the whole of it. The whole of it. Eh? You take the whole of. But if you realize that it is still, this one had the, if you realize that something had the, if you realize that there was this, as you prepare the working, okay, as you take to the other, if you realize this is a positive, as you take it to income statement, you take only this. Then when you're doing the computation of NCI, you don't forget to bring this impairment when you're, because you'll be looking for the profit to be shared by NCI. The profit to be shared by NCI. You remove this impairment. In income statement, you take this one under administrative or cost of sales, depending on where it is recorded. Then as you do the computation for NCI, what should NCI be, what NCI should share, you reduce the impairment loss. Okay, so you will have the working here. These numbers, my prayer is that in an exam you can at least gather like 25. At least you can gather like 25. So we are done with this working. I don't know whether you are tired. We can stop here because now we cannot. We are left with one of HL or one of AL. I think one of AL is not. We can continue, isn't it?
Yeah, it's okay.
Not number 8. When you add here, what do you get? like the total here. If let's say you add these figures, these ones, in a currency, this one plus this, plus this, plus this. Are you seeing what you get?
19,900.
If you were to prepare your net asset summary here, if you were to prepare the net asset summary here, the net asset summary, at acquisition, your net assets will be at the total, will be at this 19, 19, this one. Let me remove
19,900.
this. This is the total. That will be your net assets at acquisition in the currency. Now, to avoid wasting time, simply do the goodwill computation. Do the goodwill computation. Goodwill computation. Goodwill computation. Which is you are in the books of AR. Now you need the purchase consideration. The purchase consideration. You have the purchase. The purchase consideration is how much? How much did you pay to acquire shares in the other entity? You paid the what?
24,000 Tanzanian shillings.
Yeah, 24,000. 24,000. You see that it is in what? It is in TZ 24,000. So it means that you first work in Tanzanian shillings, TZ shillings. Okay. Then less the what? Less the parents' share. Less the parents' share at the parents' share of net assets at acquisition. You have them. It is 80% times what? We saw that
19,900.
19,900 in TZ. So it is 80 times 19,900. That's what you get. So the goodwill of the parent, it will be this one minus this. So that is goodwill of the parent. Goodwill of the parent. But still, when you look at our question, they told us that at acquisition date, at the date you acquired this, at the date you acquired, what was the fair value of NCI?
6,200.
6,200. So it means that you need to look at the fair value of NCI at acquisition date. At acquisition date, which is a 6,000 in TZ, 6,200. Then you raise the NCI's share of
net
assets at acquisition, which is the 20%.
20%.
Times what? Times 19,900. And what do you get? The 20% times 19,900. So NCI's goodwill is this. It is still also positive. So goodwill of the NCI is that one. Then total goodwill, it is this one plus what? Plus this one. That is the total goodwill. The total goodwill. Then you raise what? You raise the impairment. You raise the impairment loss. The impairment loss is what? From the question, what was the percent?
15%. 15%.
15%. a 15% times 8,420. What do you get? So finally, so you get this minus this. That is the goodwill carried down. But this figure is in what? This figure is in
Tanzanian shillings.
Tanzanian shillings. So you have to translate. So when you're translating this goodwill, this is at reporting date. This is at reporting date. Now, if you want to know the goodwill, this goodwill, if you want to know it very well, okay, some people put here exchange rate, like in Ugandan shillings, like you're translating this figure at acquisition, it was what? But I find it really time consuming. Then here you put all these ones, because these ones are at acquisition date. These ones are at acquisition. These ones are at acquisition date. Here you are multiplying. Just a minute, I want to show you something, because this times this, but this approach takes time. It really takes time. It really takes time. The total goodwill, it is this plus this. That is the total goodwill of the parent. It takes time, yet you would have avoided that. Then here at acquisition date, it is still what? This one. So you get this times this. Then here still it is this. Even here it okay, you get this times this. Then here it will be this minus this. That is the one of the NCI. That is the one of the NCI. If you use that approach, then it finally the total goodwill, you get what? The one of the parent plus the one of the NCI. Then you rest the impairment. This impairment is coming at year end. Do you agree? Oh, even the impairment, even if you don't say that it is coming at year end, simply get the 15. Are you saying that? Get the 15 times the total goodwill, isn't it? Because the answer you get in what? In Ugandan shilling, then you get this minus this. That's how you deal with the converting. But I want you to observe, mostly when you're doing, of course, you will need to do retained earning, and you need to record something. Now, take note. Let me hope whatever we are doing is right. Let me hope whatever we are doing. The percentage was what? 15?
What impairment?
Mm.
Yeah, but let's confirm.
The impairment was, yeah, it was
yeah,
15. Eh? Okay. All right. All right. wonder how I have a lot of figures. Nope, I didn't. Here I added, which is wrong. This one minus, it should be a minus.
Yeah, because here I tried to translate and it was giving me 11 something. So
It should be this.
mm,
Sorry, I had made an error here. I had made the error here. It should be like minus this. Okay. Okay, we are here. Now this is goodwill in Ugandan shillings. This is goodwill in what? In TZ.
eventually,
Okay. Now, what does this one mean? But how did we get this?
the 7157.
How did we get this? Because how did we get this? If you get this, the goodwill of the parent plus this one, I think you get this. Statue.
Just a second. Oh, we made an error. 8080 plus 2220. Yeah, 10,300.
So it means that now if it is goodwill at closing rate is equal to the 8755, the 7855. Then times what? Times 1.56. The rain is coming. Let me try to finish. The goodwill should be this. The goodwill should be this. Are you seeing that? But because you are getting the goodwill as this, it means that the difference between these two values, is as a result of exchange rate. Even if you get, let's say, okay, that is a shortcut you can use. It means that here the exchange rate, you have a loss. Now here, if you translate, you'll be getting a loss. Exchange loss. Someone who have used this approach of doing this exchange loss on goodwill translation. On goodwill translation. Someone who has used this approach, this is how you do it. You get this figure minus this. If you realize that the goodwill on translation is less, then what you get will be exchange loss. But if you realize that once you convert, this figure is greater than this, then you get exchange gain. Now, what if a person didn't use this approach? What if a person didn't use this approach? For you, you used this. How do you get the exchange loss? How do you get the exchange loss? Get the goodwill at closing, the goodwill carried down. Then we get 8755 schedule, then times what was the initial exchange rate? 1.58. Okay, that is initially, which should be giving you what? At this times 1.58, which should be giving you this. it is giving you this. If I round off to the whole number, it is giving you this. Then using the other, also compare it with, if you use the goodwill at
reporting date.
At closing rate, which is 1.56, it gives you what? It gives you this times the one of closing rate, 1.56. It gives you that, a whole number, you get this. So if you compare the two, you see that if you were to record that initially, you would have recorded at this, but now you are recording it at this, which is now at a loss, at a loss of
175.
this. This is the exchange what?
Loss.
Exchange loss. And this, remember this exchange loss, this one, this exchange loss should affect your financials, should affect your retained earnings.
Retained earnings. Yes.
So you debit what?
Retained earnings.
You debit the group retained the earning. Does it affect also the NCI?
I think it affects just the goodwill.
Pardon?
But it affects it because we got a positive NCI and we have been using it throughout.
Pardon?
I'm saying it is affecting it because we got a positive NCI and we have been using it throughout.
The exchange loss affects only the retained earning. It is only the impairment loss,
which affects both the retained earnings and
which affects both things.
Okay.
It is the impairment loss. The impairment loss will be allocated because now at this date, it's who is recognizing this? The parent.
The parent, yeah, I've got it.
Who is recognizing this exchange loss? The parent.
The parent.
Okay. So it means that this one will go directly to retained earning. You debit it. You debit it. Then you credit what? Here you credit what? The goodwill.
Goodwill.
Isn't it?
Yes.
Okay. So you don't forget that when you're doing your retained earning, this figure, don't forget include the retained earning. Then also don't forget the impairment loss, the impairment, because this impairment for it. But if you get this times, does it come out clearly, guys? If you get this times 1.56, do you get the same answer? I think it is almost in line. Because if this impairment loss you're getting here should be translated at what? At closing rate. At the date you are, at the impairment date. So this one, if you use this one, then you are going to multiply by this. But all of you almost get the same answer. So here the impairment loss, the impairment loss is this one. If you use this approach, how you get the impairment loss, simply get this times the exchange rate. Okay, so this impairment loss will also affect, will also reduce your retained earning. But it should be shared because this one, the goodwill of the NCI was positive. So you get here 80% times NCI. 80% times 2411. 241.
2441.
Then here you also debit NCI, which is what?
20%.
20% times 2441. When you are doing the working is for retained earning, don't forget this. Don't forget this. Don't forget this. Okay. All right. I think we are done. Then total goodwill. The one you should recognize in the balance sheet. It is this one. It is this one.
The 13658, and then we less this 175.
When you are recognizing in the balance sheet, what do you take?
The 13658.
It is raining here. I can't hear you. Increase.
13658.
So the total is when you get the first one was this one, HL plus the 13, this one, the 13658 58. The 13,600 600. You are getting the one of HL, the one of
which
HL,
is 8,
which is the one of HL, which
860.
is this one, plus the one of AL, which is 13658. Do you have something like this?
22266.
So that is what you recognize. That is what you recognize. You don't use this one because within this one there is exchange.
Exchange loss.
There is exchange loss which you must remove. So you come here where you have goodwill. Do you have goodwill somewhere? Yes, here.
Yes.
This is not number what?
8.
Pardon?
Not 8.
Not 8. So you put here the figure as 266. And you're done. And you see, almost everything is done. What you're left with is not number 8, not number 9, not number 9. That is about the group. We can look at NCI. Anyway, let me start with group retained earning. That the question is not getting done. Okay, here you start with the parents' retained earning. What is the parents' retained earning from the question? What is group retained earning? What is the parents' retained earning? Are you seeing this?
78,480.
This is 78
78,480.
like this.
Yes.
Then you add the post-acquisition profits.
It is 480, not 400.
Pardon?
480.
480. Then you add the post-acquisition profits. You have the one in the one of HL and also the one of AL. In HL you hold what? A 60.
13,360.
So 60 times what was our post-acquisition profit?
13,360.
13,360. From our workings here. Then here it was how much? This is 80% times what was post-acquisition profit? Do you recall the post-acquisition profit?
It was 27 something. Just a second. It was 27,370.
You recall from translation, we translated it.
It was 27,370.
It was not number 2 here. Post-acquisition profit, this one. So it was this
27,270. 370.
27,3. This is 27. This is 27. 27 what?
370.
370. That was our post-acquisition profit. Here, what do you get? Then here, it is
8016
times 27 at 370. Then next, what else do we do? Do we have anything to add?
Yeah.
Do we have a gain somewhere? We had a gain. The exchange, the forex exchange.
We had the one for
gain on investment property. Do you recall that? Do you recall that?
We had 450.
Are you seeing this figure?
Yes.
Yes. So it is credit. Whenever you are crediting, you add. So you add it here. What else do you add? We don't have any other add.
Intragroup transactions, we had the 30,000.
Forex exchange. Forex exchange loss. I'm competing with Roine, so it is hard for me. Forex exchange loss is, it was on what? On goodwill. That was how much? On goodwill, on goodwill of AL, this one. Remember, you debit retained earning. When you are debiting retained earning, you are subtracting. What else?
We had the intragroup transactions.
Pardon?
Intergroup transactions, we had the one of 40.
Intragroup transaction. Intragroup transaction. So we are supposed to add or trace. We eliminate the intragroup and realize the profit on closing stock. We are eliminating it. It was how much?
The first one was 40.
You add and give me the total. Get this one.
40 plus 30.
This one.
70.
That is 70.
Mm.
That is 70. Then you raise. What else? What do we raise? We raise the impairment. The impairment loss. The impairment loss of how much? You add. The impairment loss. Get this one. Plus what you get here. But can you hear me very well?
I can hear you.
Okay. So the impairment loss, we are getting this figure plus
We are getting 3,4,4, 3,244. Three, 3,244.
this one, eh?
We are getting 3,244.
Looks like I'm adding wrong things, eh?
You're adding wrong things. You have to get
The
the other one
impairment
to
loss. Bananga, the rain, it is this. The impairment loss. It is, where is it?
You first go up.
Are you saying this one?
No, up.
This one,
This one, yes.
So it is, you are getting this one, 2152. Then plus open bracket. I have
80% times 2241.
80% of the
2441.
one of AR. The one of AR impairment loss is
it is 2441.
2441. Let me hope that is okay.
Yeah, that's
total,
what I'm getting.
That's what you have?
Yes.
Okay. Then next, are we done? I think. Do we have any other?
We are done. That's all.
I think that's all. The question is taking 4 hours. We add this one plus this plus this plus this, then minus, when I do this, it will be wrong. It is this plus this plus this plus this, then minus this minus this minus this. That's what I have as retained group
Earnings.
Group retained earnings. That's what I have as group retained earnings. You go and put it here, because I want to really finish here. I don't have time to repeat this. So this is not number what?
Number 9.
Number 9. And we are seeing that it is how much? It is
105,353.
It is 105,353, like this, eh?
Yes.
Finally, the last note is an NCI. The last note is on NCI. Note number 10, the NCI. So as you look at NCI, you start with the HL. You first handle HL. You first handle HL. What do you start with? What is the fair value? What is the fair value? The fair value of NCI. What was the fair value of this HL? What was the fair value of this HL? At acquisition date.
12,600.
This is at acquisition date.
It was 10,096.
It was 10. Are you sure? HL?
Hold on a second.
HL.
Yeah, it was 10,096. You're saying at acquisition?
Just a minute. NCI,
it is 12,600.
It was this one. Yes, it was this one. At acquisition, 12,600. 12,600. Then here, do the adjustments. Add the post-acquisition profit. Post-acquisition profit. For them, they share what? They share 40% times what? What was the post-acquisition? 13360, isn't it? This is 40% times 13360. This is what you get. Do we have any other adjustment? You go back at your workings and see whether you have anything that affects HL, NCI of HL.
We have the impairment. Impairment loss.
What about this?
Yeah, even this one.
Unrealized profit, we eliminate unrealized profit. So we come here and eliminate. You less the unrealized profit on closing stock. That was what?
20 million.
Pardon?
20 million.
20 million. I just write 20.
Yes, 20.
Then what else? Now you start from your workings and move slowly by slowly. So you're done with this one. Do you have any other? This was only for the parent. You don't have any CI here. You have here. You don't have any CI. But there is something we forgot.
What?
I have realized. Remember, this was not recorded. Put a star here. There is something I have realized. Okay, I will comment on it. Remind me.
Okay.
And then let's continue. Because whenever you make adjustments, the fair value adjustment, they should affect your what? Your profit, your statement. It should affect. You will need to go and see whether we have the brand name in the question, whether we have the intangible assets in the question. Okay. Okay. Do we have any CI? Yes, we have any CI here. Are you seeing this impairment loss? So let's the impairment loss, which was what? 40% times the what? 40% times 40% times
2152.
2152. 2152. This is 40% times 2152. I think that's all with the HL. I think that's all with HL. Add sum. When you no. Get this plus post acquisition profit minus this. And that's what I have. That's what I have. Then what about this will be NCI, the NCI, then NCI carried down. What about AR? What was its fair value? The fair value of NCI at acquisition date. Do you have that? What did we record?
Okay.
Hey, before we continue, I have remembered something. Now, before we continue, remember initially the NCI was 40, isn't it?
Yes.
But now NCI is what?
20.
The NCI is 20. So that one will have an impact on what you're doing. It will have an impact.
No, I think this one is for AA. It is for AL.
It is for what?
AL, not HL.
It is for HL.
Just a second.
It is for HL. HL. Initially, you had 60.
That's right.
You acquired what? 20. So NCI reduced. So what does that one mean? It should have been this one, but we have, this is before. This is before. But after this is the NCI as at this date, the value of NCI as at this date. But now, after the 20% stake, you will need to reduce the NCI. You have the reduction. You need to reduce this one has reduced by what? You need to raise. You need to raise what? You need to raise this one by 20. Initially it was 20. Now you want to reduce it by 20. So it will be just 20 out of 40. I don't know whether you understand it better like this.
Yes, I'm understanding.
Then we multiply by this one. We reduce it. So this is over 40 times this one.
$85.
That's what you have?
85.
So it means that what you'll be left with is what? This one minus this. You'll be left with that as your NCI. So you'll be left with this. This is NCI at reporting date.
No, the impact is here.
Yes, the impact is here because now the NCI value is no longer this one. As you close off, the NCI has reduced by what? By 20.
20.
We pay the cash of, there is something I want to confirm. You paid the 4,500, isn't it? That is cash.
Yeah.
4,500. Then what was the share exchange? The value of the share exchange? The one that we said that it is investment in the investment somewhere. There is where I said investment in what? When I was making
investment in HL, it was 12,902.
It
It was
was this one,
12,902.
this one,
Yes.
12,900 oba mbadde mbiwandiisewa. Okay, let me put it here. So when you add this plus this, are you seeing what you get? I think I did the same one. Okay. Oh.
This is 4 billion, 4.5 billion or 4.5 million.
This is billion or million? Let me see.
It's billion.
This is, oh, it is in a billion. When we add, it is 4.5 billion. We add other 3 zeros. So when you get this plus this, do you see what you get? This is the total investment. This is what you, this is the total investment. This is the total investment in what? The money you injected, the money you injected. Okay, so what does that one mean? What does that one mean? Okay, in million, that is approximately what? 17402, isn't it? In millions.
Yes.
In a million. So that is what you invested to acquire that what? That 20%.
20%.
So what does that one mean? What does that one mean? It means that the double entry you're making here is to debit. You're reducing the NCI. You're reducing the NCI by what? By this figure. By this figure. Okay? But you made an investment. You made an investment. Investment in what? Investment in HL. You made an investment. You increased your investment by what? By 17,420. Are you seeing that? This is like cash, the cash you paid. This is like the cash you paid. Okay, you look at the money you paid, the money plus the share exchange. That is what you paid. So the difference between this and this is where students make mistake. The difference between this and this is what we call this one will go to reserves. This is you debit the what? You debit the reserves. Because that figure would have reduced the reserves. You debit this is like the loss, the balancing figure. So this is where the issue is. Whenever there is what? Whenever there is an increase in acquisition, whenever you increase your stake, the NCI will reduce. The NCI will reduce by this figure. Are you getting that? Reduction. Yeah. This is reduction in NCI. Reduction in NCI. In any NCI. NCI. Then you know what is your investment? How much did you incur? This is like the cash or bank, or depending on the mode you paid. This is here we are seeing that you paid through cash and what? Share exchange. I believe you know that. You know that now. So the balancing figure will reduce your reserves. So you go and reduce your reserve. Okay.
The NCI for
AL, what was the fair value? Fair value of fair value of NCI at acquisition. It was what?
Can you go back to the question, please?
I thought you had recorded it. We had translated.
It was 6,200.
It was what?
6,200 times 1.58.
And you got how much after translating?
9796.
9796. Like this, eh? We are getting this one, eh? This exchange rate, this one, this okay, this figure times 1.58, isn't it?
Oh, the 2,400.
We are getting the two. No. Anywhere, 81 positive, which note? We are getting 6. This is the NCI 6. We are getting 6,200 times 1.58.
Yes. Which is giving us 9796.
Okay. Then you add. Oh, we first do in dollars and translate everything. Okay, add what was the post-acquisition profit? Post-acquisition.
It was 27.
This is the one for this one. Eh? Remember, it is what? The stake is 20. Eh? So 20% times the post-acquisition profit.
27. 370.
20. Pardon? You read one by one.
20. 370.
This is after getting 20% times post-acquisition.
No, times 20% of this. Times 20% of that.
Or I multiply by 20%.
Yeah.
Okay, do we have any other? We are getting that post-acquisition from the second note, this one here.
During the translation.
The balancing figure, this one.
During the translation.
Do we have any other? AR, you have the impairment, eh? Are you seeing that?
Yes.
So here bring the impairment loss. Erase the impairment loss, which is 20% of the impairment. Impairment was 2441, eh?
Yes.
Do we have any other? I think that's all.
That's
Get
all.
it plus this minus this. So that is your total NCI. So the total NCI that you should take in the balance sheet carried down. You get the one of AR, your HL, which is this one, plus what?
13,382.
And that's what you get. So you record this one in your balance sheet. Here, this is not number what? Not number 10. It is how much?
21914.
As NCI. I hope you have not left something out. So that's all. But there is something that we have not tackled here. When you look at this, our note number, our net asset summary, our net asset summary, where here we recorded brand name. Initially, it was not there in the book. Do you agree? Initially, it was not there. So you should record it, yeah? And how do you record it?
It's under current
That is the name
non-current
of
asset.
what?
Brand name.
A brand, that is the name of intangible asset. You can call it intangible, isn't it?
Intangible assets.
Asset. In a bracket, that is like your brand name. Brand name. You are recording it at its. This was not number what? Not number what? 3? Oh, not number 6.
It was not number 6.
Not number 6. You're recording its carrying value, which is 7 what? 700.
700.
What was the investment in associate? The investment in associate was 780. That one we have no adjustment. Now add. Do we have things that affected the impairment? I don't. Do we have things that affected the PPE? I don't think so.
No.
Even here, you just cross. You see how these things can be easy. Then inventory, you just.
But can you reach even this side?
Then you never know. Here, then here, you cross.